Hey everyone. In this video, I wanted to dig a little deeper in Rivian's plans to achieve profitability on gross profit margin by the fourth quarter of this year. I wanted to take a little bit more interest in their steps towards profitability, how they plan to bridge the gap between these massive losses they're generating on the bottom line and gross profit right now into becoming eventually profitable. So I thought this was interesting, some of the strategic changes and the improvements that they're making and the opportunities they see to further improve their profitability. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So management saying that beyond the engineering opportunities, when compared to the R1, the R2 also has significant cost opportunities through competitive sourcing. So the R2, they plan to launch later, probably in 2026, but they're already seeing the benefits of the R2 initiative right now because they're negotiating with suppliers and telling them, look, right now we might be purchasing a certain amount of supply for, 50,000 units. But we plan to get up to nearly 200,000 units. And we can make a deal with you today that brings that into our existing contract. So we can sign a 3-year deal that says, or a 4-year deal that says for the first 2 years, we're going to get enough inventory for, 50,000 units. And then for the second 2 years, we'll get enough inventory for 200,000 units. And so they could tie it into the existing contract that will benefit the R1 cost of goods sold. And that's kind of what they've done already. And from the supplier side, they like that option. Suppliers can generate more economies in scale if they're producing larger quantities. So if you're agreeing to purchase larger quantities from suppliers, then they're willing to give you a lower price per unit. So that's what Rivian's been working on. I think that's going to be one of the major reasons they can get to gross profit margin in Q4 2024. So another thing they decided is to start production of R2 in their Illinois plant, the Normal plant, Normal being a city in Illinois. And this will provide flexibility to manufacture an estimated 215,000 total units per year, which will include 155,000 units of R2. Remember, previously, they had been building a manufacturing facility expansion in the state of Georgia. But now that they've realized they don't have a lot of demand for their vehicles, right? This year, there's going to be no growth. 57,000 unit production. They did 57,000 units in 2023. So zero growth. And then on top of that, they're producing 57,000 units this year, and they have the capacity to produce 215,000 in the current facility. So why spend money on a new facility if you're not even reaching capacity, if you're not even reaching half of the capacity of your existing facility? Makes no sense, right? Of course, a couple of years ago, that may have made sense when the initial thoughts were that demand for electric vehicles is going to be through the roof and we're going to need to expand manufacturing to keep up with demand. But reality is setting in, right? Less than 1 out of 10 consumers are choosing an electric vehicle when they go out to buy a car. It is what it is. They are less convenient and more expensive. I must have said that over 100 times now. But that's the reason why people are not choosing electric vehicles at less than 10% of the rate. And that's likely going to continue until these electric vehicle companies can improve the charging speed and charging range and lower the price of these vehicles. So they need to make these improvements to get greater consumer adoption. And this is a step towards that, right? Building in your existing facility means you can utilize that facility to a greater degree, which can deliver better profitability and save a ton of money. In fact, they're going to save $2.25 billion by not expanding that Georgia facility by pausing construction and keeping it here, the R2 production in Normal. And on top of that, they were able to negotiate an incentive from the state of Illinois with the value of up to $827 million. So Illinois provided a little sweetener saying, look, why build that expansion in Georgia, right? We'll give you an incentive to retool your existing facility here and produce your R2 line over here. And that way you'll provide more jobs in the state of Illinois, and we'll sweeten the deal with $827 million. So that, in my opinion, was a no-brainer for Rivian. You at least want to have 50% utilization of your existing manufacturing facility before you consider an expansion. Otherwise, you're just being wasteful. And I think this is prudent for Rivian. So those recent retooling upgrades in the Normal facility, the team made meaningful progress, and they're now back to producing R1 vehicles on the production line. So they had to shut down production so that they can make those improvements, and those went according to plan, and now they're back up and running. And that's been something Rivian's been good at. This is, I don't know, maybe at least the second time they've had to pause production and make improvements. And both times they did it as planned. It didn't take longer than expected. They didn't have big trouble, and they continued on at better margins, at better efficiency. So they are demonstrating good progress on their plan. They've been one of the better performing electric vehicle startups in recent years. Of course, you've probably heard of all of the difficulty in other electric vehicle companies. Fisker's on the verge of going bankrupt. Lordstown Motors, I think, already went bankrupt. There's several others that are on the brink and losing so much money without any progress. Rivian's been one of the better performing electric vehicle startups in a market that's been saturated with all of these poorly managed electric vehicle companies. And that was a result of all of that EV frenzy in 2020 and 2021, when tens of billions of dollars of investor money flowed into these electric vehicle startups that had, in my opinion, no reason for coming into existence to begin with. And that's sometimes what happens when investors get ahead of themselves and get a little bit too excited about something before tangible results were delivered. All right, so they're also improving the flow of materials and inventory within the plant. These changes are expected to improve cycle time, utilization, and cost. So here we are, first quarter completed of 2024. Management retooled, made progress, and reiterated their target for gross profit margin positive by the fourth quarter of 2024. Now, that's not the end of it. They've got a lot more work to do even after that, but that's just a key milestone along its pathway. It's very early days for Rivian. You've just got to deliver, and you've got to hit these milestones so that investors can have confidence that you're making progress, and you'll eventually get to a point where you're profitable and self-sustaining in the long run. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.